everyone. Welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Naj, an economic and market research analyst for TMX Verify. In this video, we're doing a deep dive into the stock market's long-term behavior by looking at the inflation-adjusted S&P Composite Index's history, going all the way back to 1871. The first thing we must understand is the market's one certainty: its cyclical nature. The market doesn't grow in a straight line. It constantly swings above and below its average path. We've used regression to trend to identify this 150-year average growth rate, which comes out to just 2% annually. The market's natural tendency is to eventually revert or regress back to this trend. Our second key concept is standard deviations. This is a statistical measure of extreme behavior. It quantifies how far the market is straying from its average trend. When the market moves into the 2 or even 3 standard deviation range, it's signaling a historically rare event. The market has been above its trend for almost 3 decades. For perspective, if the S&P 500 were sitting on that long-term trend line right now, its value would be around 2,257, instead of the 6,840 the index ended October 2025 at. Now, look at the historical peaks. The great runs leading up to 1901 and 1929 topped out at 94% and 77% above the trend. Even the late 90s tech bubble peak in 2000 was an unprecedented 106% above trend. But the last few years have completely shattered these records. In 2021, we hit 162% above the trend. By the end of last year, it was 180%. And as of the end of October, the market has reached an astonishing all-time high of 198% above its long-term trend. This level of variance is absolutely historic. Now let's quantify this extreme with the standard deviation bands. One standard deviation represents about 46% move away from the trend. Historically, peaks were typically around the 2 standard deviation level, and troughs consistently drop to more than 1 standard deviation below the trend. Notice how past crashes involve declines exceeding 50%. The 2008-2009 financial crisis, often cited as a generational crisis, only briefly dropped to 29% below the trend, which is actually above the typical historical low watermark. However, the current rally is operating in uncharted territory. The index approached the 3 standard deviation range in 2021. But most recently, starting in August of this year, for the first time in history, the S&P Composite Index has officially moved into the 4 standard deviation range, where it remains today. We are witnessing an unprecedented statistical extreme. The market's nearly 200% above its long-term growth trend, putting it firmly in the 4 standard deviation range. Historically, such periods of extreme overperformance have always been resolved by a regression back to or below the trend line. What remains unclear is the path and speed of that correction. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.